Imagine you have some money, you could spend it today, or you could hold on to it. Why might you choose to hold cash? Liquidity preference is the desire to hold assets like cash. Cash is liquid, it's easy to spend. People hold cash for transactions, precautions, and speculation. Transactions demand for money is straightforward. We need cash for daily purchases. Precautionary demand is about having a safety net. You might hold cash in case of emergencies. Finally, speculative demand is tied to uncertainty about the future. The interest rate is the price of money. It's what you earn for lending money, or it's what you pay to borrow. Interest rates play a crucial role in balancing the demand and supply of money. When interest rates are high, holding cash is less appealing. You miss out on potential earnings, so the quantity of money demanded decreases. Conversely, low interest rates make holding cash more attractive, increasing the quantity of money demanded. The money supply is determined by the central bank. The central bank can increase or decrease the money supply through open market operations, reserve requirements, and the discount rate. Changes in interest rates have a ripple effect throughout the economy. This is because interest rates affect investment spending. Lower interest rates make it cheaper for businesses to borrow money. This encourages businesses to invest in new projects and expand. Increased investment leads to higher aggregate demand. Higher aggregate demand, in turn, boosts economic growth. Conversely, higher interest rates discourage investment. Businesses may postpone projects. This decrease in investment can slow down economic growth. The effects of interest rates on investment are a key channel through which monetary policy influences the economy. Section 4, Money Matters: How Monetary Policy Influences the Economy. In this section, we will explore the crucial role that central banks play in shaping the economic landscape through their monetary policies. Central banks use monetary policy to influence the money supply and interest rates. These tools are essential for maintaining economic stability and fostering growth. Expansionary monetary policy aims to stimulate the economy. This type of policy is often implemented during periods of economic downturn or recession to boost economic activity. It involves increasing the money supply. By injecting more money into the economy, central banks can encourage spending and investment. When the central bank increases the money supply, interest rates tend to fall. Lower interest rates make borrowing cheaper, which can lead to more loans and credit availability. Lower interest rates encourage borrowing and spending. Consumers are more likely to take out loans for big-ticket items like homes and cars, and businesses may invest in expansion. This increased spending boosts aggregate demand and can lead to economic growth. When people and businesses spend more, it creates a ripple effect that stimulates various sectors of the economy. Contractionary monetary policy, on the other hand, aims to slow down the economy, typically to combat inflation. Inflation occurs when there is too much money chasing too few goods, leading to rising prices. It involves decreasing the money supply. By pulling money out of circulation, central banks can help reduce inflationary pressures. This can lead to higher interest rates, which can slow down the economy. Higher interest rates make borrowing more expensive, which can reduce spending and investment, ultimately cooling off an overheated economy. Section 5, Government Spending and Taxes, Fiscal Policy in Action. Fiscal policy is a crucial tool used by governments to manage the economy and ensure stability. Governments also influence the economy through fiscal policy, which involves strategic decisions about government spending and taxation. Fiscal policy involves changes in government spending and taxes. These changes can have significant impacts on economic activity, employment, and inflation. Expansionary fiscal policy aims to stimulate the economy during a recession. This is achieved by increasing government spending or cutting taxes to boost economic activity. When the government increases spending or cuts taxes, it injects money into the economy. This can lead to more jobs, higher consumer spending, and overall economic growth. This increase in spending leads to higher aggregate demand, which is the total demand for goods and services within the economy. Expansionary fiscal policy can help to pull an economy out of a recession by encouraging businesses to invest and hire more workers. Contractionary fiscal policy, in contrast, involves decreasing government spending or increasing taxes. This approach is often used to cool down an overheating economy. This is usually done to reduce budget deficits or control inflation, which can become problematic if left unchecked. However, it can lead to a decrease in aggregate demand, potentially slowing down economic growth and reducing consumer spending. Section 6. Amplifying and offsetting effects multipliers and crowding out. In this section, we will delve into the intricate dynamics of how economic policies can both amplify and offset economic activities. Both monetary and fiscal policies have multiplier effects. These effects are crucial in understanding the broader implications of policy decisions on the economy. The multiplier effect refers to the idea that an initial change in spending can lead to a larger overall impact on the economy. This concept is fundamental in macroeconomics and helps explain how economic activities are interconnected. For example, if the government spends $100 million on infrastructure, this spending doesn't just disappear. It sets off a chain reaction of economic activities. The money goes to construction workers, suppliers, and others involved in the project. These individuals and businesses then have more income to spend. These individuals then spend a portion of their income on goods and services, which in turn supports other businesses and workers. This cycle continues, creating a ripple effect throughout the economy. This ripple effect can amplify the initial impact of the government spending, leading to greater economic growth than the original amount spent. However, fiscal policy can also lead to crowding out. This is an important counterpoint to the multiplier effect and must be considered in policy making. Crowding out occurs when government borrowing reduces the availability of funds for private investment. This happens because the government competes with the private sector for the same pool of financial resources. If the government borrows a significant amount of money, this can drive up interest rates. Higher interest rates make borrowing more expensive for businesses and individuals. Higher interest rates can discourage private investment, offsetting some of the stimulative effects of the government spending. This can lead to a situation where the intended boost to the economy is partially neutralized. Understanding the balance between these amplifying and offsetting effects is crucial for effective economic policy. Policymakers must weigh the benefits of increased spending against the potential drawbacks of higher interest rates and reduced private investment. By carefully considering these factors, governments can design policies that maximize economic growth while minimizing negative side effects. This delicate balance is key to achieving sustainable economic development. In conclusion, the concepts of multipliers and crowding out illustrate the complex interplay between government actions and economic outcomes. By understanding these dynamics, we can better navigate the challenges and opportunities of economic policy. Section 7. To intervene or not different perspectives on economic policy. Economists hold varying views on the role of policymakers in stabilizing the economy. Some economists believe that active intervention is crucial. They argue that policymakers should use monetary and fiscal policies to counteract economic fluctuations. Other economists are more skeptical of government intervention. They argue that government policies can have unintended consequences. They often favor a more hands-off approach, allowing markets to adjust on their own. The debate over policy intervention is complex and multifaceted. There is no one-size-fits-all answer. The appropriate role of policymakers likely varies depending on the specific economic circumstances.